Okay, let's unpack this. The last 24 hours have delivered a severe stress test to the digital asset world. And this goes far beyond just a standard price fluctuation. We're witnessing a critical juncture really defined by two simultaneous compounding shocks hitting the ecosystem. Our mission in this deep dive is to dissect these dual pressures that drove Bitcoin's price down by nearly 4%. First, you had this sharp contraction in monetary liquidity that, flushed out a lot of market players. And second, we saw a massive unexpected shock to the underlying infrastructure, a huge mining disruption. The headline metrics, they tell a pretty painful story. Bitcoin breached that critical $86,000 support level, declining 3.72% over the reporting period. As of this morning, the price is sitting at $86,429, and the market sentiment index read a chilling 11. That's deep in extreme fear, true capitulation territory.
What's so fascinating here is that the market is being pulled apart by two very different structural stories. You have the sudden physical contraction of the network, the severe geopolitical disruption from a Chinese mining shock. Hitting at the exact same time as this strange divergence in institutional behavior. One group is buying the dip aggressively, while, general equity investors are running for cover. We need to understand how these two forces interact.
Okay, so let's start with that monetary side, the sudden collapse in confidence. We saw a clear technical breakdown where the asset failed to find any bid density around that $89,500 mark, and it just plunged down to an intraday low of $85,171.
And that plunge didn't happen in isolation, not at all. It reinforced a really concerning re-emerging correlation with U.S. equities. We saw the sharpest leg of the decline coincide almost perfectly with weakness in the NASDAQ composite, which is down 0.59%.
And the S&P 500 was down too.
Down 0.16%.
Right.
Bitcoin is currently behaving like a high beta technology stock, meaning it moves faster, more violently than the overall market. It's reacting dramatically to these global shifts in liquidity.
The velocity of that decline was just incredible. Was this primarily spot selling from, say, long-term holders? Or did a mechanism in the derivatives market just amplify the drop?
It's the second one. The velocity was driven by the structural instability in the derivatives market. It's the classic long squeeze. We saw over $583 million in leveraged positions liquidated across the broader market.
In just 24 hours.
Just 24 hours. And crucially, approximately $474 million of that total represented long positions. So people betting on the price going up were the ones forced to sell.
Is $583 million truly staggering in a $1 trillion asset class? Or does it just look big because the market was already thin?
It's staggering in its velocity. This amount tells us the market was heavily, maybe over-leveraged for a rally. And when that support broke, the automated stop-loss orders just turned into a waterfall of forced selling. The vital insight for you, the learner, is this. Because the move was driven by this leverage flushing rather than deep spot distribution from long-term holders.
There's a chance for a faster recovery.
Exactly. There's a technical potential for a V-shaped recovery.
Okay, walk us through that mechanism. Why does clearing out leverage facilitate a quick rebound like that?
Well, when a leverage position is liquidated, it's not the holder choosing to sell. It's the exchange's engine automatically selling their assets at market price to cover the debt.
So it's forced selling.
Pure forced selling.
Yeah.
And these forced sellers create a momentary flood of supply. Once the system clears that leverage supply, once all the, dead wood is gone, the market is left only with natural spot buyers. That scarcity of supply can allow the price to rebound very quickly and fill the gap created by that cascade.
So, assuming that leverage is now cleared, where's the battleground? We need to know the critical lines the spot market has to defend to avoid a deeper correction.
The primary support level and the current battleground is between $85,000 and $85,500. Defending that area is absolutely critical. It aligns with the 78.6% Fibonacci retracement level.
Which is a key technical level for chart watchers.
A very key level. It's often the deepest possible correction you see before a previous trend is expected to resume.
And if we lose that, what's the line in the sand?
Then the true line in the sand comes into focus, the secondary support at $74,000. If that level is violated, we shift the market regime from a temporary correction back into a full bearish trend. If $74,000 fails, the medium-term bull market thesis is severely compromised.
Okay, looking at momentum. The daily RSI is approaching the oversold threshold. It's at 36.7. That historically signals a localized exhaustion point for sellers, right? They might be running out of steam.
It can, yes, but you have to respect the fact that the SED, the moving average convergence divergence, has already flashed a confirmed bearish crossover. That means momentum traders, the people who follow short-term trend changes, are probably going to sell into any relief bounce we get.
So if the price action was tough, the reason for it, this infrastructure shock, is what really complicates things. Here's where it gets really interesting. Let's talk about Xinjiang and the magnitude of this coordinated mining shutdown in China.
This is a story of global hardware just suddenly going dark. Reports confirm that approximately 400,000 mining rigs went offline almost simultaneously, and that caused the global hash rate, the network's total security and computational power, to just plunge by an estimated 100 exahashes per second.
That number sounds huge, but give us some context. What does 100 exahashes really mean?
It means an 8% decline in the global network's power in a single day. To give you scale, 100 EHs is roughly the entire processing power of the Bitcoin network back in mid-2020.
The entire network.
The whole thing. So that is a massive security budget just vanishing overnight. A huge immediate shock to infrastructural liquidity.
This sounds like history repeating itself after the 2021 ban. What collapsed this so-called gray zone this time around?
It's a classic case of discretion failing. After the 2021 ban, estimates suggested China had quietly returned to controlling up to 20% of the global hash rate. They were using stranded energy excess power in coal-rich provinces like Xinjiang, and this was tolerated through a sort of tacit don't ask, don't tell equilibrium with local officials.
But somebody started talking.
Exactly. Operators started promoting their massive mining sites on Chinese social media platforms like TikTok and Rednote. That visibility just flagrantly violated the equilibrium. The central government, which needs to maintain strict control over energy consumption, was pretty much forced to intervene. We're talking about a shutdown impacting 1.3 to 2.0 gigawatts of power capacity, enough to power about 1.5 million homes.
So this is a state-level policy intervention, not just a technical glitch. Okay, what are the immediate economic implications for the market of 400,000 rigs suddenly losing power?
The immediate implication is high capitulation risk. These operators now have zero revenue, but immediate liabilities, debt service on expensive hardware, energy bills, potential fines. They will likely be forced to liquidate their Bitcoin holdings to cover those costs.
Distressed seller.
The definition of a distressed seller. And that anticipated flow just exacerbates the current spot price drop. It bridges the infrastructure shock directly to the monetary shock.
But the downside for them creates an upside opportunity for others, I imagine.
Exactly. If these machines can't be immediately relocated inside China, which is likely to be sold off overseas, that's going to flood the secondary market. It will crash the price of ASICs, the specialized hardware. And this provides a massive opportunity for well-capitalized, publicly traded miners in North America, the Middle East, South America, to upgrade their fleets at a steep discount.
Which accelerates that decentralization trend we've been watching. Okay, let's shift focus to corporate dynamics, because this is where the institutional divergence gets really sharp. We have Strategy Inc., formerly MicroStrategy, doubling down in just spectacular fashion.
Maximum conviction. They disclosed purchasing another 10,645 BTC for about $980.3 million, which brings their total holdings to a staggering 671,268 BTC.
So what does this all mean? Despite nearly $1 billion in buy pressure, the market responded by punishing MSTR stock. It fell about 7%. What gives?
The market is signaling fatigue over the mechanics of their strategy. First, just look at their cost basis on this new batch. They bought at an average price of $92,098 per BTC, with Bitcoin now trading around $86,000. That entire new tranche is immediately underwater. But the deeper insight is this. Strategy Inc. funds these purchases by selling their own equity. Their whole model relies on their stock maintaining a massive premium to the value of the Bitcoin it holds. When the asset price falls, the dilution risk, the sheer volume of new shares they have to issue, it just overwhelms the confidence signal of the purchase itself.
That makes perfect sense. So they're a pure directional bet on the asset. But another key institutional player, Ark Invest, is making a very different kind of statement. They seem to be focusing on the picks and shovels.
That's a crucial difference. Ark executed a series of high-conviction buy-the-dip moves, but they focus heavily on infrastructure plays. They're signaling belief in the long-term transactional layers of the ecosystem.
Specifically, we saw Ark buying, $17 million in Bitmine, $16.26 million in Coinbase, $10.8 million in Circle, and even $1.24 million in their own ETF, ARKB.
They're building a diversified portfolio of infrastructure, and buying their own ETF serves a strategic purpose. It provides liquidity during market outflows, and it signals internal confidence. The firm is showing it views this price dislocation as a temporary event. Historically, this pattern of counter-cyclical infrastructure buying has been a strong indicator of perceived value during these periods of extreme fear.
Speaking of liquidity, we also saw capital drained by the non-crypto tech sector. The surge in Tesla's stock, driven by their positive robo-taxi news, kind of acted as a vampire, didn't it? Drawing speculative capital away from crypto in what is already a liquidity-constrained environment.
It absolutely reinforces Bitcoin's current status as a risk-on asset. When there's a shiny, high-beta tech story somewhere else, speculative capital often rotates out of crypto to chase that momentum, which just amplifies the price weakness.
Okay, now let's wade into the fog of war that is the U.S. regulatory environment. It's sending extremely mixed signals. We have some good news and some major caution arriving at the same time.
On the good news front, the U.S. Financial Stability Oversight Council, or FSOC, delivered a significant win for the industry. They removed cryptocurrency from its list of systemic financial threats in its 2025 annual report.
Okay, for the listener, what does this de-escalation mean practically?
It means top regulators no longer view crypto as an existential threat to the dollar system. For traditional banks, this clears a major hurdle. That systemic risk label previously carried prohibitive capital requirements and, frankly, regulatory hostility. It clears the runway for Wall Street to get even more involved.
But then you have the caution.
Right. The caution came from SEC Chair Paul Atkins, who warned that crypto could become the most powerful financial surveillance architecture ever invented, if not properly architected. He's drawing a line between permissionless chains and centralized compliant ledgers. He's suggesting the SEC may actually prioritize consumer privacy rights and demand architectural choices that prevent total financial surveillance.
That's a sophisticated and slightly unexpected position from the SEC.
It really is.
And that nuance is so important, especially when we look at liability. We just saw Coinbase lose a private arbitration case, and they were ordered to pay $618,000 to a client who lost funds in a cyber attack.
This is huge. Historically, exchanges have worked hard to absolve themselves of user-side hack liability, but the arbitrator in this case ruled Coinbase failed its duty of care. They cited inadequate security safeguards and, quote, selective amnesia regarding a vendor breach notification.
So this sets a serious potential precedent, forcing U.S. custodians to reimburse users for losses from social engineering. Can you explain what social engineering means in this context?
Sure. Social engineering is just a technical term for losses that happen when a client gets tricked, through phishing emails or scam calls into giving up their credentials. This ruling suggests that if the exchange's own internal defenses are deemed insufficient, they can no longer just blame the user for clicking a bad link. They have to prove their security infrastructure was robust. It fundamentally alters the risk model for all U.S.-based crypto custodians.
So if we connect this to the bigger picture, you have these external regulatory pressures, and they're being compounded by internal battles over the soul of the protocol itself. The governance fight right now is centered on a controversial new soft fork proposal, nicknamed the CAT.
Yes, the CAT, or the non-monetary UTXO cleanup. It's highly contentious because it touches on the fundamental principle of permissionless usage.
Proponents argue that the chain needs to be cleaned of things like ordinals and stamps. They claim these are exploiting the witness discount to store arbitrary data, like JPEGs, which bloats the UTXO set. Let's define those two key pieces of jargon for our listener.
Absolutely. The UTXO set unspent transaction output set is essentially the ledger. It's the list of all unspent coins. If it gets too large, running a full node becomes expensive, which threatens decentralization. The witness discount is a mechanism that was intended to reduce transaction fees for certain data, but is now being used to store these JPEGs on the cheap.
But the other side sees this very differently.
Oh, completely. Opponents view this cleanup proposal as protocol-level censorship, a violation of the network's neutral nature. Their argument is, if developers introduce a way to filter JPEGs today, what stops them from filtering politically undesirable transactions tomorrow? It's a slippery slope argument.
And the controversy was inflamed by some incredibly aggressive language in a related proposal. It used wording that implied a moral and legal impediment to rejecting the soft fork, which many saw as trying to use state-level threats to coerce consensus.
And it is crucial to clarify one thing for the learner here. This controversial, destructive the CAT cleanup proposal is not the same as the constructive OPCAT, BIP 347. OPCAT is a proposal to re-enable an old code that allows for advanced smart contracts like covenants. It's widely supported as a positive upgrade.
Got it. So don't confuse the censorship proposal with the smart contract proposal.
Exactly.
And amidst all this Bitcoin turmoil, we are seeing some interesting divergence in the altcoins. The demand seems to be broadening out.
Indeed. U.S. spot XRP ETFs just recorded their 30th consecutive day of net inflows. They've surpassed $1 billion cumulatively. This unexpected strength highlights that institutional capital is broadening its base. Even as Bitcoin faces a massive leverage flush, the demand for legally clear, lagging assets like XRP is proving resilient.
Okay, time to synthesize what we've learned. The market is trapped right now. It's caught between these powerful secular tailwinds like the regulatory de-risking from FSOC and the institutional interest from Ark, and these sharp cyclical headwinds, the equity correlation and the painful mining stress from Xinjiang.
My strategic verdict is that the extreme fear reading of 11 is a powerful contrarian buy signal. The Xinjiang shock is a one-time structural event. The hardware doesn't just disappear, it relocates, which ultimately accelerates decentralization. So once the market absorbs the distressed selling, the fundamental thesis driven by corporate treasury buying and ETF inflows remains firmly intact.
So for you, the key monitoring points are watching the defense of that $85,000 level in the immediate term and monitoring the hash rate. We need to see if that missing 100 EHs starts relocating quickly. All right, here's a final provocative thought for you to mull over. Given that the FSOC has declared crypto safe from systemic risk, clearing the path for traditional finance, yet the SEC chair warns about its potential as a powerful surveillance tool, how much more centralization are institutions willing to accept in pursuit of compliance, especially when internal governance proposals like the CAT raise such serious fears of protocol censorship, something for you to explore on your own.